Good morning, good afternoon, or good evening, depending on where you are, and thank you for joining us for this exciting panel session as part of the Invest Africa Connect Mining Summit on Environmental and Social Governance, or ESG. To start, I think it's fair to say that ESG has, for good reason, now become a fairly embedded part of our language, practice, and way of thinking in the mining sector, arguably more so over the last 12 to 18 months. ESG is, in my opinion, now not just something which is the subject of lip service or which reflects an antiquated idea that these are the issues or domain of objectors or shareholder activists, but rather a meaningful set of considerations which the industry as a whole has come to embrace, and which is resulting in an industry-wide drive towards sustainability and responsible and ethical corporate citizenship. The topic of today's session is ESG and mining sustainability in 2021 and beyond. My name is Jamie McDonald. I'm a director in the Finance Projects and Restructuring Group here at DLA Piper. I'll be your moderator today, and I'm joined by an esteemed panel which reflects a really great cross-section of the industry for purposes of this topic. In introducing each of the panelists, I'd ask that the panelists give a wave so that we can put names to faces and you, the audience, know who is speaking and who I'm talking to. To start with, we have Adeobi Naruka, who's the Chief Operating Officer at Genesis Energy, which is a private energy developer. Shirley Weber, who's Head of Natural Resources Coverage at the financial institution, the ABSA Group. Michael Rawlinson, who's the Non-Executive Director at Hochschild Mining. And last but certainly not least, Freudis Cameron Johansson, who's the Head of International and Government Relations at Anglo American. So perhaps to start off the panel with the theme of G, Michael, you sit as a member on the ESG committee for Hochschild Mining, and not only that, you do the same function for Adriatic Resources. How do you go about formulating your policy positions and standards with respect to ESG?
Yeah, sure. It's interesting. I mean, Hochschild, I've joined a company that's been going for 100 years, and Adriatic is a startup. We've had to start everything from scratch. But in both cases, it starts with the chairman and the CEO really setting the tone. The tone is set from the top, and if they think it's important, they decide how important it is and what standards they want. And it's an interaction with management, a sit-down session about what we think is the right culture and approach to take. And we decide we want to be the best and we want to be socially responsible, and we've got to make that happen. And a lot about that is creating a culture in the company. So it's training sessions and sessions where you're asking management to come together to bring their ideas about and set their targets. And there's a lot of external resources which allow people to set these targets as well. I mean, the ICMM is the industry group that really set up by the diversifiers, to which now some of the big gold companies are members too, and they have what they think are good standards for things like safety, emissions, CO2, climate goals, diversity and inclusion, etc., etc. But that's one set. But there are people like the GRI, Sustainalytics, the MSCI, Sustainability Group that also have their own metrics. And you've also got the legalistic versions of the things that the financiers care about, the equated principles and some of these. So there's a thicket of different standards you look at, but it's really about what do we think as a company and culture is appropriate, and let's adopt these standards, adopt them as formal targets, and report against them quarterly in a public forum and annually in a sustainability report where you set your goals.
Excellent. So you mentioned the ICMM principles. Freudis, perhaps a question for you. We as lawyers view the world through the sort of binary lens of the mandatory versus the voluntary, in the sense that, the mandatory is the regulatory requirement which you must comply with, but they're also the principles that I've just mentioned really fall into the voluntary category. Anglo's really at the forefront of the voluntary category as far as I can see. So as a founding member of the ICMM, with this in mind, how do you think voluntary standards, such as the mining principles, will impact the sector going forward in the medium term?
Thanks, Jamie. I agree everything with what Michael was saying, and I think the voluntary standards are sort of the starting point. So again, trying to make things mandatory for international organizations outside of the local national regulatory environment is difficult. So I think the voluntary standards that we've seen, and it's not just the ICMM principles, it's also the voluntary principles on security and human rights, which have been around for a long time, the UN guiding principles on business and human rights. And then, of course, you have, a number of sort of internationally recognized standards. So the IFC performance standards in relation to resettlement, engagement with indigenous peoples, etc. So there's lots of standards out there, voluntary or mandated. And I think for us, where we come from is about what are we going to ensure that we do to ensure that we're living by our purpose and our values and really delivering for our stakeholders the most responsible type of mining that we can. So I think the ICMM principles are a really fantastic start. They're sort of geography and commodity agnostic. They give a sort of guide as to what companies, regardless of where they're located or operating and what commodities they're in. But I think it's basically nowadays, it's almost like baseline, so a hygiene factor. I think what investors and communities and other stakeholders are really looking for is how are you going beyond these hygiene factor sort of voluntary standards? Show me, how you're implementing these voluntary standards, because again, subscribing and saying you're going to do these standards, if you're not actually really delivering on them, they're literally not worth the paper they're written on. So it's a lot about demonstrating that you are really delivering against the standards that you're subscribing to. I think the other thing that I think people are really looking for now is the sort of independent assurance process around a lot of these standards. So as Michael was saying, there's a lot of sort of reporting requirements out there. How are these all being independently verified and assured? And I think where the direction of travel is going is, okay, not only you as a company subscribing to whichever standards you subscribe to, how are you actually ensuring that you're delivering on those and they're being independently assured? And so one of the other organizations that Anglo was a founding member of is IRMA, which is about sort of the independent mine assurance. And this has taken 10 years, over 10 years actually. So the Anglo representative has had 2 children in this time, has had a number of different life events. And I think the reason where IRMA is now, it's taken a long time to get there, is because the founding principles were essentially that it was multi-stakeholder from the very beginning. So you had unions involved, you had NGOs involved. So you were actually getting a proper holistic sort of viewpoint on what people cared about and what they wanted to see responsible mining undertaking. And so having that multi-stakeholder approach with an independent assurance model, I think is definitely the direction of travel that stakeholders, investors, governments and communities will be looking for responsible business to really undertake. And if anything, ESG is now very much become mainstream. And so I think all of these things are what people need to be really thinking of and what they actually mean for them as a company.
Great. So I think in the voluntary space, there's a fair amount of benchmarks and standards which are available. One mining executive commented to me the other day that, in fact, they were spoiled for choice. Freudis, just as a follow-up question for you, how important do you think that there's some level of convergence between these benchmarks and standards in the future?
Oh, huge. I mean, it's exhausting. I mean, I think one of the investors I spoke to sort of talked about it as a sort of, mushroom industry. You sort of look around and there's a new standard, there's a new index. And then again, talking to the investor community, they're now using a lot of algorithms to just kind of do scraping to really see what companies are signing up to and what rankings they're getting from various indices. So if you're not participating in an indice that an algorithm is using, you could be sort of negatively prejudiced potentially. So for me, where I'm sitting, I think, oh gosh, how do you know which one to choose? It's not like you sort of wave a magic wand and your submission is done. It does require an awful lot of work because there is no standardized approach. So I think it's very important for us to all kind of come together to really think about, well, what are the questions or what is the information that people need to really evaluate companies? And again, investors just don't have time to spend the sort of hours and hours on one-on-one to really understand companies. But again, you also want companies to be able to represent themselves in the right way, where the questions that are being asked of them are realistic and appropriate. So I absolutely believe there should be whether it's a convergence or a standardization, just to sort of help people navigate this from across the value chain. So we even have our customers saying to us, we have no idea what's good or what's bad. So we know that you are a member of, IRMA, Responsible Steel, and these things, but is that leading? Is it middle of the road? Is it baseline? We also know that there's, all these other indices where you rank. So our customers are now finding it increasingly challenging on how to sort of do a sort of fair evaluation as well. So I definitely believe there is a huge value in a lot of the indices and the rankings and all of these different approaches. But again, how can we bring them together more so that you're not sort of deluged continuously, and you actually start to simplify and make sure that we are disclosing things. And I think the transparency is hugely, hugely important. But just because you dump a whole bunch of information externally doesn't necessarily mean it's digestible or comprehensible to the people that are reading it. So how are we asking the right questions to really ensure that responsible companies are disclosing and actually demonstrating what they're doing is what they say they're doing is what they're actually doing?
Right. So a lot of this, I mean, it's all well and good to say that investors are concerned about sustainability, but I think they've become quite intrusive about doing it and really are after finite detail about the investments that they make. Michael, you're involved not in your capacity with Hochschild and Adriatic, but in another capacity in conducting the investor perception study for a major mining house. Can you tell us what this study entails and what some of the recent major themes of this study are?
Sure. Yeah. So every year I get involved in working with a major and calling up their top institutional shareholders, and it's about 60 calls. It was in person, but then it was a lot of Zoom calls this year or last year, and you're going in with a set of questions to really understand why they're investing and so on. And interestingly, the corporate in question really wants to ask a lot more about ESG and how people felt about ESG and what their priorities are, and was the company spending too much time on it, too little time on it? Was it missing something? Where did investors stand on specific issues like Scope 3 emissions, those kind of things? And what was interesting for me in terms of the things that came out of it was how on the matter of ESG, it's very clear that whilst it was on the radar a few years ago, now it's front and center, and the level of importance that these institutions place on it has mushroomed. And some of these very big household name $1 trillion fund managers, they typically all have processes on ESG now where they didn't before, and really to make an investment they need to fill out sometimes 25 questionnaires around suitability specific to that industry, say mining, and giving an ESG report on a company as a precursor to being able to invest in it. And that's sort of been driven by, yes, the institution moving on it, but the people who give the money to the institutions, they don't want to give the money to that institution unless there is an ESG process baked in. And so you often find a situation where you call up one of these big institutions, there's a grizzly old fund manager who kind of hates this stuff, but he knows he has to get in the game to keep his job, and he can't invest and so on. And then the ESG group who set the standards, they sort of tell the mining fund manager that they've got to worry about scope 3 and things like that, and they get very frustrated. But it's these dramas are being played out in the institutions. But there is this movement to more of a consensus as how they move forward. But it's one thing is for sure, it's not going away, and the hurdles are rising.
Right. So that's I guess that's the equity market's perspective. Clearly, that's not the only source of capital for mining houses. Surely, as a debt financier, as a financing house, how has ABSA's approach to ESG issues in the mining sector changed over the last few years, and how do you expect it to evolve in the short to medium term going forward?
No, thanks, Jamie. I think there's definitely been a change in the way, like Michael have explained, how equity funds look at, for example, investments, etc. I think the financial institution environment's also changed in the same way. When we consider projects, etc., we also look at the corporates and see if there's a clear and a transparent strategy in, for example, the impact of the corporate and the funding that they will be getting from us as a financial institution. How will it impact the economies, the communities, the environment, etc.? So things like that is definitely at the forefront now as well. I think everyone is expecting financial institutions to be a bit more responsible when we look at especially new projects, and the type of projects that we are looking at. I think it's important to note that there's, we've signed up 130 banks from about 49 countries, signed up to the United Nations Principles of Responsible Banking. And the purpose of that entire framework is to make sure that every financial institution's business strategy actually meets up, with society's goals as well. For us, that's also very important, because more governance, more transparency, as well as accountability, it becomes now daily life for all of us. I think, from ABSA's side, we are committed to support, Africa's, the economic growth. We are looking at diverse energy projects as well, from our side. And clearly we're sitting in Africa, and Africa is still largely dependent on coal as well. However, corporates we've seen understand that banks are going to look at a diversified portfolio mix, in this whole energy framework. So the corporates are definitely looking at those as well. I do think as well with ABSA and the way that we look at the transition of energy, especially now, 2020 showing us that, people are looking at the energy transition a little bit more, in depth. Renewable power is one thing, but looking at where we are in the mining side, the battery storage technology, etc., it's there. We actually need to focus on that. And I do think as well, even sovereigns, all countries will realize, because of Africa and where we are, and there's a vast number of energy minerals sitting there, corporates, governments, countries, as well as financial institutions will look more and more to those type of energy minerals and see that it can lead to a better energy mix for the world.
Well, that leads us very nicely onto the subject of emissions and clean energy. At AOB, you're a private energy developer, and ESG obviously presents somewhat of an opportunity for you. Can you give us an idea of some of the engagements and discussions that you're having with mining clients around ESG, sustainability, and clean energy solutions at the moment?
Okay, so we come across a variety of mining clients and on our day-to-day business with varying needs. Some things that stand out for us are sometimes you have mines that are maybe they only have 4 to 5 years left in their life. Some are greenfields off the block, and so we try to offer them solutions that would work for their needs. We have like a range of solutions, efficient gas-fired solutions that utilize LPG or LNG where available, in combined heat and power applications so that they're more efficient. So you're getting more bang for your buck for the fuel that you burn. And typically they're cleaner than if you're burning HFO or diesel. So this typically works really well for mines that are off-grid and really have only need choices that will give them reliable power 24 hours a day. We also do solar and solar hybrid solutions. So depending on location, if it's a place that has really good solar incidence, for example, we're doing solar and gas hybrids or solar and diesel hybrids, and inclusive of storage as well. Like Shirley mentioned, we have a lot of innovative storage technologies these days. And so sometimes it's even just how do you optimize your existing equipment. Sometimes that's what works for a customer. And then in some certain markets where there's a lot of small hydro locations, we've also had conversation about small hydro to power mines as well as neighboring cities. And
Great. Without,
in terms of commercial structure.
sorry, continue.
Go ahead, Jane. No, I was just going to add that in terms of structure, we'd also do some leasing and rental arrangements, which typically is preferred when it's a shorter term life, or like an IPP structure type agreement if it's longer life.
Great. Without, breaking any rules of confidentiality or giving away any commercially sensitive information, can you give us an idea of some of the projects that you're working on?
A really good one that comes to mind is in Zimbabwe, we have a project that's 200 kilowatts and it's being run on LPG. So this is like a family-owned mine, a gold mine. It was running on diesel 24/7. And it's a location that's so remote, and it would have cost them a lot of money to connect to the national grid. And so what we've done is bring in a micro turbines and using LPG, and we're able to do that at a cost that's cheaper than running diesel for them, and it's also cleaner for them as well. Another one I think is a 600 kilowatt solar diesel storage hybrid solution in Zambia. For a mine, as well as the staff and then the community. There, I think one of the most tricky parts was trying to figure out how do you provide power to the community in a way that doesn't then impact on the operations of the mine. So I think that was an interesting project as well. In the end, they decided on a phased approach, first starting with providing power to the mine, and then over time, expanding the production capacity of the solar plant so that it could feed the communities. A third one is actually greenfield. We're still in the very early planning stages of it. It's like a 7 megawatt LPG fired with a 4 megawatt peak of solar. And it's in Asia. So what we're very, very early stages, because what we did was do a comparison for them to see how much money they would save, because originally they had planned to run off of diesel. So two things that came up was that because it's gas fired, in terms of maintenance, it's cheaper, which means you don't need as many units. And to add to that, I think the LPG costs were cheaper. We came out to about a 21% or so estimated cost savings from switching to the solar LPG solution versus diesel. The most interesting one on the hydro front was in the DRC, where there's a hydropower plant that's not working anymore. And there was a company looking to invest in a mine in the area. So what we had done was do a feasibility. So we did a feasibility for the restoration of the hydro power plant. And then you could do up to 30 megawatts and then transmit that to the mines and to the other claims in the area, as well as to the cities. So for us, typically, we just want to see what you have available. So when we speak to mines, we want to optimize that in the best way that meets your cost reduction targets, as well as your emission reduction targets.
Great. So Freudis, maybe to turn this over to you, what's Anglo American doing to meet its climate emissions goals and targets in Africa? A wide question, I grant you, so maybe one or two examples or explanations would be great.
Oh, those were some great examples just now. Just what you can do with the infrastructure that's there, because of course infrastructure is one of the biggest issues when it comes to power. So we have, we're very much focused on our South African operations for our commitments in the climate space. We've made commitments to be carbon neutral in scopes 1 and 2 by 2040. Very aggressive goals there. And the big thing that we need to really be thinking about on scopes 1 and 2, especially in the South Africa context, is around the use of renewables, because fundamentally, the grid in many African countries, especially South Africa, is still powered by thermal coal. So how are we going to support them with the energy transition that they need to work through as part of their own commitments? So the use of renewables, then we're very much pushing forward on, again, from our diesel substitution, how we can get now more into the hydrogen space. So with hydrogen now being a kind of sort of energy vector and also storage solution potentially, how we could use that for, say, the haulage trucks when we move into some of the more automation sort of operations as well. So really, really big focus for us on decarbonization in South America. We actually, again, it's all about the access to the renewable power. So again, access to renewable power in South America is much more readily available. So again, use of hydro and renewables is quite strong there. So for us, it's a sort of combination of the use of renewables, thinking through the portfolio. So again, if you're looking to decarbonize your entire portfolio, you need to be looking at what commodities are going to be the ones to be in, not just from a sort of decarbonization perspective, but also what are the metals and minerals that the low energy future needs. So again, big focus that we've seen around, copper, cobalt, again, all of the minerals that are needed to actually power the sort of vision that people are hoping that we're going to be able to realize. Efficiency. So again, this statistic still blows my mind about one of the highest uses of energy in mining is in comminution. So we break big rocks into smaller rocks, and that takes a lot of energy. So in terms of actually making operations and what we do as an industry much more efficient is a huge focus for us. So a lot of our tech dev team and the technical team are really looking at how they can increase efficiencies in terms of just usage, and then of course how we can just use less of everything. So using less water. So could you actually in the future have a mine that has no freshwater abstraction? A carbon neutral mine within its own footprint. So those are all the things that we're looking at. And then of course the two last things are really about abatement. So for us as a business, we're very heavily in the steel sector, and of course abatement of or trying to decarbonize the steel value chain is a big focus around carbon capture, storage and reuse. And for that we really have to work up and downstream the value chain. So up and downstream of the value chain to really think about what partnerships we can really solidify with our customers, with our logistics chain. So how we can think about that. So again, we're looking at how we can reduce the carbon in our shipping. So again, a bit like the cleaning up of the generation in Zambia, it's how can we actually clean up some of the vessels and the fuel usage that they have there. And then finally, you can't really, in my view, talk about decarbonization as a business if you're not also supporting the decarbonization and transition of the communities to a resilient, low carbon future. So, Adobe was just saying how important, the community power infrastructure is, especially around these operations, and we absolutely concur with that. So how can we support the communities around their power infrastructure that is going to be resilient, and also ensure that we're not just still dependent on diesel or continuing sort of fossil fuel generation, but how we can really make that transition. So even you look at somewhere like South Africa, and it has huge mineral wealth, but it's how we now can potentially frame South Africa to be thinking about its renewable power wealth. So again, with the wind and the solar that's available in the Cape, huge opportunities there. And we hope that we can be part of that journey for South Africa to realize that decarbonized future.
Yeah, so just staying with the energy theme, South Africa's been very successful in its renewable energy program, but one of the things that I think we're still developing is the ability to provide energy solutions to mines, and I think that that's true of Africa. And a good litmus test is whether financing is required for those types of infrastructure. Shirley, are you seeing any increase in the appetite for financing, not just the mining operations, but energy solutions to power mines?
Jamie, yes, definitely. We've seen more and more requests for funding coming through the system, especially over the last 24 months. Obviously, there were certain announcements being made, that made it possible, for mining houses to set up, plants, close to their operations as well. So, by mentioning that, that's obviously one of the alternatives, either the mining house setting up their own plant, and obviously owning it and using it. And if there's excess power that's been generated, they can obviously send it down to the grid as well, or sell it down to the grid. Or alternatively, independent power producers, doing it, setting up the plants and obviously selling the power through to, the actual mining houses. So it's definitely happening more and more. The requests are actually streaming in as we speak. I think the competitiveness of these green power solutions, it's definitely increasing because the pricing is reducing, compared to the tariffs that we've seen of the traditional, the Eskom's, etc. Those tariffs are not necessarily decreasing as we speak. So one additional thing that's coming in is also a focus maybe on natural gas, the LNGs, the liquefaction plants that's being set up. We've seen as well that becomes a very good alternative, to many of the winds and solar and traditional coal-fired power plants as well. So, and that also becomes a very real alternative whilst everyone is working through battery storage technology, which it seems is still a bit more expensive compared to many of the other technologies out there. But in time, because of where we are in Africa and the access to those assets, we think it's going to change. So financing to mining houses, it's definitely happening. And obviously reducing dependencies, on certain old traditional plants as well.
So sticking with a theme that's come up in the context of power, which is the community, which both Adeobi and Freudis have touched upon. I'd like to sort of turn towards the community because I think any conversation in the context of where we are today and the pandemic, etc., deserves some level of consideration for the community. And so, Michael, perhaps back to you. Since the inception of the pandemic and given your role on the ESG committees, have you had to change your approach to ESG? And has this impacted the way in which you think about and engage with local communities?
Yeah, sure. The pandemic itself has obviously had a huge impact on our workforce, and in Peru in particular, it was the worst place affected in the world. 30% of people have had coronavirus in Peru. So we had amazing testing regimes where it takes you days to get up to the mountains. These things are, 5,000 meters. So you'd have to pay for hotels to people to come get the test, wait for 5 days, then drive them up, extend shifts, put on more healthcare. People with a BMI above a certain amount couldn't come. People who were too old couldn't come. So it had a huge impact on our workforce and so on. The communities itself, they were very scared, and they didn't want the activity. So we stepped away from drilling as much to give them comfort that we wouldn't be doing things that kind of upset them. We laid on more services for them because they were scared to leave their communities, but it meant that they couldn't get supplies and so on. So we provided things like that. More healthcare, and we gave them health support as well. And it's it's a rare moment when, with mining, when you build a mine, these communities didn't ask you to be there. And it's inherent in that tension is all you can offer is jobs or taxes, but often the taxes that you are collected, they don't go back into the local community. So it's actually been quite a good opportunity for us to be able to show that we're good corporate citizens, that we can give more than just jobs and tax to the central government and make their lives easier and help them in what has been a very stressful time.
Yeah, I mean, certainly in our experience, we've seen the pandemic result in forced closures or short-term care and maintenance regimes, which obviously have an impact on the mine, whichever way you look at it. And it creates an inherent tension with some of your social obligations. Freudis, has the last 12 months changed or affected the way in which you interact with communities and address social issues? And have you put in place any measures for them?
Yes, I don't think it's changed how we interact with communities. We've always been, communities have been at the forefront of much of our thinking. But what I think it really put into sort of stark relief for us as a company is the sort of art of the possible in a very short space of time. So we put together what was called the We Care program, and there were 4 pillars to the We Care program, and it was really about sort of our colleagues and employees and contractors about their physical health. So again, what, as Michael was saying, what is the testing protocol? What are the PPE? What's the PPE that we need? How are we actually going to send people underground or into a mine, which is, an environment of close proximity? How do you de-densify and socially distance an operation? And then there was the mental health. So again, I think the biggest change that I've seen is around how companies and society actually, I'm in the UK, the sort of much more open approach to mental health and mental well-being. So we made that one of the 4 pillars, put a lot of focus and a lot of effort around that. The communities was the 3rd pillar that we put into the We Care program. So it was about how do we ensure, because where we have our operations, there is nothing else really. So, there were big discussions at the beginning. Was mining going to be shut down? Was it not deemed critical? But, you shut down a mine, you shut down, the access to water or to a whole bunch of facilities. So it was really critical that we had a balance in what was possible in terms of operation and how we supported the community with the services that the mine really supported in. So we were doing everything from, basically everything. So water, care packages, food packages, working with local NGOs from the delivery side, working with the local municipality and the government. So the community response was very, very much part of our thinking, and that also stretched to the health stuff as well. So ensuring that where we had testing capacity, if that was needed, could we support the local communities as well? And then the 4th pillar that we had is what we called living with dignity, which is actually Anglo-American gender-based violence sort of focus area. So how are we actually supporting our communities and our with the massive increase in what was a horrific experience for a number of people, not just in South Africa, but we had this, in all of our jurisdictions, people are locked down and locked in abusive relationships. And actually, how could we continue that work that we had started and really make that one of the pillars of the We Care program so we could support people when it really did matter. And that was, we're not experts in that space at all, but we worked with the National Shelter Movement in South Africa. We worked with other organizations and groups that were very well positioned to support victims and also perpetrators, again, because of the stresses that were put on. How could we actually try to ensure that what we were doing was making just the situation just less bad than what it was across the sort of physical, mental health for everybody that we could support. So it's been it's been an incredible year for all sorts of reasons, both good and bad. And I think for us as a company, the realization of what was possible in a time of crisis to keep things running in the safest possible way, and also ensure that we're providing both our colleagues, employees, contractors, and communities with as much support as we possibly could. And of course, that now carries on as we go into the recovery phase. So we're all hoping that now with the vaccines, that, you know, economies can start potentially getting back to whatever, I won't say normal, but whatever the unlocked status looks like. And we very much want to make sure that we're playing our part and supporting our part. Anglo American's got a really strong history of basically supporting public health interventions. So we really led the work around HIV and AIDS. And it's how we can, again, sort of utilize the infrastructure that we have, both from a health perspective, but also logistics perspective, to really ensure that we're supporting where we can for this next phase in the pandemic.
I think we're just conscious of time. We've got time for one more question, and I'd like to just revisit something about electrification or the sort of confluence between electrification and the community. Adeobi, you mentioned that you're involved in a couple of those projects, and of course, that is a difficult discussion, and one that we often encounter in the context of our projects is you know, the mine's obligation to electrify or contribute to the electrification of the surrounding community. Can you give us an idea of some of the projects that you're working on, and whether you think that that's an increased area for opportunity, or at least participation by mining houses?
Keep forgetting to unmute myself. I think that electrification is critical because it has multiplier effects on the community, right? In terms of productivity, in terms of quality of life, in terms of access to healthcare, electrification is very important. And so in terms of when we do projects with companies, we're having conversations around how do you want to achieve this? It's one thing you can have an extension, but then you face a bit of a push and pull, right? Because once you reach out to the community, you have to know going in that consumption is going to grow with time. And so how do you want to address the sustainability of your community electrification? So are you going to, so I'll give you an example. It's not, for example, there's a cap on, and it's a prepaid meter, and there's a free amount every month. And so once you hit the cap, that's it. It means your consumption is going beyond what is considered normal for a household of a certain size. So it's kind of a way to find like a middle point where you're giving enough power to people to power their lives. And when they get to a point where their use is beyond like residential use, and you're going into productive use, so more commercial use, then you want to encourage people to actually start to pay something for the additional power that they consume. Why? Not because you don't want to give away the power. It's because you want to make sure that people are being, they actually you do so you don't that are optimal, so that you're providing power and they're also valuing that power in a way that maintains the sustainability of your plant. and sometimes a mini-grid solution that's separate from the mine power. Why do I say this? Because in that way, you can build a bit of community ownership, where you're creating jobs for people who live in the society, in the community. They're responsible for operating, running this asset, and they're more likely to protect it because they see it as something that's theirs versus something that belongs to the mine. So when you have sometimes communities that are restive or unhappy, like the tension that I think Michael mentioned about not even wanting the mine to be there in the first place, these are some of the things that we see that help mitigate that, because now they have a mini utility that they have responsibility for, that provides electricity in the day, they can pump water, they can have healthcare centers that work. And then just and if you do it right, it can become self-sustaining or self-sustaining, productive use as part of the total consumption. And people have to look at power solutions, especially when you're bringing in the communities, not just as CSR. You want to have something that works long-term, and you want it to keep working even when the mine is no longer, there.
Great. Well, I think that brings us to the end of our panel session time. We have a couple of questions in the chat, which I will read, and the panelists are open to take these if they so wish. So question one is, since the Paris Climate Accords, we've seen a series of mining companies set emissions targets, but very few have addressed plans to measure or reduce scope 3 emissions, being those produced by the end consumer. Could Freudis and Michael touch upon why those scope 3 emissions are seen as more challenging to measure and reduce, and whether they see a credible path to net zero emissions that would include scope 3?
Wow. I'll start.
So that's fairly specific and fairly pointed.
It was very interesting when I did my survey of investors about scope 3, and I'd say 60% of the investment community didn't want scope 3 at this stage, but there was a recognition that the naysayers thought they'd probably be having to say yes in the next couple of years, and this movement is underway. And for those that don't know what scope 3 is, it's measuring the CO2 emissions of your customers, and that's where it gets tricky. So if you're a producer of let's say iron ore or copper, well, where does it go, and how much CO2 is used in its end use processes? So the iron ore industry, case in point, the carbon is used to make steel at the moment, and you can do that. But do you know where all of your tons go, and to which steel mills, and which ones are trying to reduce carbon, and so on and so forth? And a lot of the places you sell your steel, they don't measure their CO2. So how can you set a target if you're the corporate? So I think it will come when people and the corporates can get a better handle of what their customers' scope 3 are, and then if you can measure it, what the baseline is, then you can maybe do targets. But clearly, it's not something you are responsible for. It's the customers have to reduce the emissions, and that's your inherent problem that the investors have. I think that's why there's so much tension in the market. But I'm sure Freudis is a lot more across the detail than me.
Okay. No, look, as Michael said, look, scope 3 is complicated. Okay, so and it is by its very nature double counting, because our scope 3, says Anglo American, would actually then be our customers' scope 1. So sort of double counting. Now the thing with scope 3 is, I think there's a lot of misunderstanding around scope 3. Scope 3, a lot of people think, oh well, scopes 1 and 2, it's all about the number and how do you get it down as a percentage. Whereas what Scope 3 was designed for was really to help, I guess, you as a company and therefore investors actually understand the intensity of your value chain, both up and downstream. So are you, is your product carbon intensive, you're selling it and it's becoming carbon intensive in its use? Are you, to make your product, is it very carbon intensive to make your product? So again, it's sort of looking at both sides of the value chain, sort of either side of your Scope 1 and Scope 2 activities. So I think, the setting of Scope 3 targets is important because, it does help you identify, and therefore investors who are becoming much more cognizant of their investment portfolio, because they now need to disclose the carbon within their own portfolios, the carbon intensity of their own portfolios. So it's ensuring that whatever methodology you decide to put forward to measure your Scope 3 is appropriate for your business, it's appropriate for you, you can then measure it, and then it's about how you are then contributing to what should be the overall objective, which is to take carbon out of the world, so to speak. So what is your role in actually trying to really decarbonize your own value chain, which would then ultimately be better for the planet? So there's huge complexity around it. There's the whole double counting piece, which I think people often get sort of fixated on. But it's not about a sort of 100 number that you will portion out. It's about thinking, how do you think about your own value chain? And again, it's, from an investor perspective, I can imagine the challenge about, well, not all businesses are the same. They may have different methodologies. So how do you ultimately compare? If somebody has a Scope 3 target, how are you actually comparing what that means and things like that? So are Scope 3 targets needed or coming? I think the answer is yes. Investors are asking this. They need it, again, like I say, for their own portfolios. It does then, really hold people to account on what they are doing around the decarbonisation approach for their own business. And ultimately, what it comes down to is partnership. So as Michael's saying, your downstream Scope 3, it's something you have absolutely no control over. But in some ways, just saying, oh, I don't have any control over it, people don't care about that. It's like, well, okay, well, what are you going to do about it? So this is where the sort of, the whole B2B approach now becomes a bit more of a B2C approach, which is, okay, how are we working with our customers to really think about decarbonizing the entire value chain? Because ultimately, our customers will probably get to the point where they need to decarbonize up their value chain. So it becomes much more of a, how are you thinking up and down the value chain in each of the different areas to ensure that you're just trying to decarbonize that entire value chain and playing your part in it, so to speak. So very complicated, but I think things are now starting to sort of unfold a bit more. And I definitely think the whole discussion around Scope 3 targets is here to stay. And it's now a question of how people navigate their way through it.
I think you're absolutely right. And the one thing I'd add to that debate is it's so much more valuable as informing strategy and future capital. So if you are running an iron ore mine and you have all your your Chinese steel mills and your German steel mills, and they haven't changed for years, so what? But there's a new innovation which is hydrogen-based steel that doesn't use carbon. If you've got a Scope 3, that's where you're going to try and make your customers. Similarly, if you've got a choice between making an investment in a lithium mine, a copper mine, or an iron ore mine, you're going to, if you've got these targets, you're going to go for the transition metals that are going to make the world a better place. And that's the key to Scope 3, I think.
Great. I think the rest of the panel breathed a collective sigh of relief when that question was pointed to the two of you. Question 2, how has COVID impacted approaches to ESG in the mining sector, and could sustainable investment into the sector help drive recovery? I think in part we've covered the first portion of that question, but I'll open that up for any thoughts or comments.
If I can maybe start, Jamie, and just mentioning how we look at it. For example, I think Freudis have mentioned, that the IFC performance standards is quite important. So when we want to finance any project, there's really 3 basic guidelines that we look at: the Equator Principles. And if you go and look at the Equator Principles, it's obviously quite a complex set of, guidelines. And it focuses a lot on, new projects or expansions of existing projects, etc. And then it boils down as well to not just the mining operation, but everything around it, for example, as well. So the communities, the water, how can we use less water, and the panel actually mentioned this as well. So we look at the Equator Principles, we look at the World Bank, the health standards, and then clearly every bank have their own criteria and guidelines in how we should invest, for example, in many of these projects as well. I do think for us, when we look at ESG, and Freudis, you've mentioned it, and Michael, and even Adua, you've mentioned a few of these things. It's not just about, one aspect. There's so many sustainability challenges that we're all sitting with. If you look at, things like, increasing unemployment, you look at, for example, there's all our natural resources, it's diminishing, things like that we really need to focus on and see what the impact is of all the development happening. And all of that becomes a climate change impact. And clearly, we are a systemic bank in about all of the places that we operate in and all the markets. And we have to acknowledge that things like, energy poverty, like we've all mentioned it, as well as infrastructure to deliver that specific energy, it's also lacking. And that also worsened these challenges that we're all sitting with. So it's a tough question, I think, and I don't think anyone's got, a proper answer to that. It's merely guidelines that we have to follow in order to deliver something, that to make sure that the whole community also benefits.
Great. I think time permitting, we'll move on to the third question. But thank you, Shirley. The last question is: how important a role does incorporating comprehensive ESG policies have to protecting the long-term future of Africa's mining sector and creating new employment opportunities in the sector? Going above and beyond the obvious answer of very important. Again, we'll ask the panel for comments and queries.
Difficult to say. It just is very important, and I don't know. I think they should be broad-based as well, because the outcomes that you have if you've got broad-based good ESG targets, not just say CO2 or safety, but also communities, also gender equity, and specific other emissions ones as well. You're really uplifting the whole industry on a social as well as an environmental standpoint.
I also think, this is what the expectations of business is. So, as Shirley said, the access to finance is conditional on these things. Make no mistake, if you're a bad operator, don't think your life is going to be very easy on the ground. So you have this sort of, the whole license to operate piece is now coming much more to the fore in terms of what local communities, in terms of them having a say. It might not be you have to go through the permitting processes for these things, but even if you've got all the permits in the world, if you are not following, a number of these sort of ESG standards, principles, commitments, whatever you want to say, your license to operate is always going to be precarious. And that doesn't make for sound investment or good operations or a successful business outcome. So I think in many ways, the whole idea of sort of stakeholder capitalism is coming much more relevant everywhere. It doesn't matter what geography you're in. I mean, we talked about Peru at the beginning. Worked a lot in Peru over the years. If the community doesn't like you and you're not doing what you said you would do, you've got big problems, regardless of what permits you have in place. And I think now, in the whole sort of idea of building back better and the sort of big focus on responsible business, and who, it's not just about getting the investment in, it's about having sustainable investment, both financially and in terms of productivity, and caring for all the areas that the ESG space is looking to really ensure that there's improvement on.
Great. Well, I think we're up for time. To summarize, I think capital will go where it's treated best in terms of its allocation towards sustainability, and so the sustenance of the mining sector is really dependent on capital flowing in for the African mining sector. And with that, I will say great thanks to the panelists for your insightful and really informative comments during this. And thank you all for tuning in and dialing into this panel session. Thank you.
Thank you very much for listening.